All right, welcome to The Explainer. Today we're basically putting on the glasses of history's greatest investors to dissect Alamo Group's latest Q1 2026 data. We're going to look right through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, and then run our own hardcore quantitative valuations to figure out, is this stock a buy, a hold, or a sell?
Here is our roadmap for today. First, a quick company snapshot. Then we hit the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll dive into the quantitative valuation and wrap it all up with the final synthesis and recommendation. Let's get right into it.
Starting off with Section 1, our company snapshot for Alamo Group, ticker symbol ALG.
So, looking at the fresh data, Alamo Group is currently trading at $150.86 a share. That gives them a market cap of roughly $1.83 billion. And honestly, their latest Q1 2026 earnings report shows some real momentum. Net sales actually bumped up 6.7% year over year, hitting $417.1 million. Now their underlying business, it is wonderfully boring. And hey, as seasoned investors, we know that is exactly where the real money is usually hiding. They are an essential business split into two main chunks: industrial equipment and vegetation management. Think heavy machinery for sewer cleaning, street sweeping, snow removal, all that infrastructure stuff. The real secret sauce here is the recurring, contract-based, government-funded demand. It's just highly reliable, non-discretionary spending. Just look at this graddle truck from their industrial division. This perfectly captures the kind of heavy, incredibly specialized machinery we're talking about here. We aren't dealing with trendy consumer gadgets. These are massive, essential public works assets with highly predictable, long-term replacement cycles.
Okay, Section 2. Let's shift gears and look through the Buffett lens.
You already know Warren Buffett absolutely loves an economic moat. Well, Alamo's moat is built entirely on those predictable equipment replacement cycles and essential government contracts. Because local governments literally have to maintain their infrastructure, it creates this very wide, stable foundation that insulates Alamo from wild economic swings. For Buffett, that is a massive checkmark.
But looking at the fundamentals brings up a really interesting conflict. On one hand, Alamo delivers incredibly consistent earnings, boasting a trailing EPS of $8.36. Plus, their debt is super manageable. Total debt minus cash leaves a net debt of just $95.2 million. On the other hand, though, we're looking at a forecasted return on equity of 12.61%. By Buffett's infamously high standards, that 12.61% ROE is kind of weak. He normally wants to see a much higher number to prove management is being exceptionally efficient with shareholder capital. Buffett also leans heavily on owner earnings. Now, since capital expenditures aren't explicitly broken out in the specific quarterly summary for us to calculate a flawless free cash flow, we're making a logical assumption. We're using their impressive $139.8 million last 12 months operating cash flow as a rough proxy. That covers over 138% of their net income, which frankly shows fantastic cash generation.
So synthesizing the Buffett framework, the Oracle of Omaha would probably admire the moat, for sure. He'd also like the synergies they've realized from recent acquisitions. But because of that somewhat modest 12.61% ROE, he'd definitely demand a lower entry price. He'd want a much wider margin of safety to offset that lower capital efficiency.
Moving right along to Section 3, the Lynch lens.
Peter Lynch famously put companies into specific buckets. Given Alamo's $1.83 billion market cap, their reliable $1.36 annual dividend, and that steady 6.7% sales growth, Lynch would absolutely categorize them as a classic stalwart. Stalwarts aren't going to double overnight, but they give you reliable, moderate growth, and they do a beautiful job protecting your portfolio when the market takes a dive.
But here is the absolute kicker, the PEG ratio. Alamo currently has a trailing PE of 18.02. With analysts expecting EPS growth of 14.42% heading into next year, their PEG ratio, price to earnings divided by growth, sits at a highly attractive 0.9. And remember, in Peter Lynch's playbook, any PEG ratio under that magic 1.0 threshold screams that a stock is undervalued relative to its growth potential.
Pair that phenomenal PEG with a rock-solid balance sheet, including over $300 million in revolver availability and low net debt, and Lynch would almost certainly stamp this a textbook buy at $150. It perfectly fits his model of a fairly priced, reasonably growing stalwart.
All right, Section 4. Time for the ultimate stress test, the Graham lens. Let's run Alamo through Benjamin Graham's strict defensive investor checklist. Honestly, they pass with flying colors.
Adequate size? Yup, 1.83 billion cap. Earnings stability? Check. A solid 8.36 trailing EPS. Dividend record? Yes, paying out 34 cents quarterly. And a moderate PE of 18.02 easily fits right into his defensive criteria.
But let's do the math. Graham's intrinsic value formula is the square root of 22.5 times EPS times book value per share. Now, since the exact book value isn't isolated in our primary source data, we can just logically reverse engineer it by taking that 8.36 EPS and dividing it by the 12.61% ROE. We derive an assumed book value per share of $66.30.
Plug in those numbers in. The square root of 22.5 times 8.36 times 66.30 gives us a strict Graham intrinsic value of exactly $111.67 per share.
So, what's the takeaway here? As solid as this company is, Graham wouldn't touch this stock today. At $150.86, it is trading at a steep premium to his $111 intrinsic value calculation. He's the ultimate bargain hunter, so he'd wait patiently for a broader market correction to drag that price down before even thinking about taking a position.
Okay, Section 5. Let's step away from the gurus and run our own quantitative valuation.
For our base case discounted cash flow, or DCF, we're forecasting out 5 years using that 14.42% expected EPS growth. We'll fill in standard industrial sector assumptions here. A 10% weighted average cost of capital to discount those flows back to today, and a perpetual terminal growth rate of 2.5%. Run the numbers, and our model spits out a fair value estimate of roughly $160 per share.
But look, a DCF is only as good as its assumptions, right? So let's check the sensitivity matrix. If the cost of capital drops to 9%, fair value rockets up to 185. But if interest rates climb and WACC rises to 11%, fair value sinks to 140. At current trading levels around 150, the stock is basically floating right in the middle of this realistic probability matrix.
We can also look at other models to verify our DCF. Applying a standard 20 times industrial multiple to that trailing EPS gives us $167.20. Meanwhile, Wall Street analysts are feeling way more bullish. Driven by that forward growth rate, their average one-year target price is sitting all the way up at $188. Finally, Section 6, our synthesis and final recommendation.
When we blend all of these different frameworks together, a really clear picture emerges. With the current price just north of 150, Alamo Group is trading right around or maybe slightly below its intrinsic quantitative values, derived from our DCF and comparable multiples. It's well below Wall Street's optimistic 188 target, but, as we saw, it's far above Benjamin Graham's bargain basement requirement of $111.
Synthesizing all of this, the final verdict for Alamo Group is a solid hold. The strengths are absolutely undeniable. It's a wonderfully stable stalwart, it's got a phenomenal lynch-peg ratio of 0.9, a deep government-funded economic moat, and massive operating cash flow. However, the risks, specifically that weak 12.61% return on equity, some slight margin compressions in Q1, and negative operating cash in Q1 due to working capital needs, mean the current price just doesn't offer a foolproof margin of safety.
So the ultimate question remains for your own portfolio. Depending on whether you prioritize Peter Lynch's growth at a reasonable price or Benjamin Graham's strict asset-based discount, does Alamo Group, at $150.86, offer you a comfortable margin of safety? Thanks so much for walking through this explainer with me. Keep analyzing, keep calculating, and I'll see you in the next one.